Hi and welcome back to the ASX Small Cap Wrap, your fortnightly fix of fresh ideas, tasty takes and maybe the occasional spicy opinion. I'm Patrick Polk, business editor at A Rich Life, founder of PLP Finance Media and certified expert in selling too soon. Joining me is Claude Walker, founder and editor-in-chief of A Rich Life, long-time small cap whisperer and recovering Twitter antagonist. Together we'll be serving up ASX small cap insights with a long-term view and a side of banter. No reheated leftovers here, just hand-picked, high-conviction investing chat. Today we'll be offering our take on Trump's recent Liberation Day announcements. Who's affected most, what it means for local companies, the local economy and global investments. So sit back, enjoy the show, and don't forget to give us a like and subscribe. Claude, good to be chatting with you again so soon.
Yeah, great, exactly. We thought we would do an extra episode this week just because it's such a big day for markets today. This morning, I think probably more than half the financial industry in the entire world was glued to their computers or screens to listen to Donald Trump's Liberation Day announcement when he liberates the world from 40 years of progressively freer trade, which has arguably driven a fair bit of economic growth, certainly an improvement in living standards. Well, if you measure living standards by access to flat screen TVs, cheap devices, etc., which I know some people do. On that measure, free trade's been great for everybody, really. But obviously, there's a new ideology in town, and also a ridiculously disorganized administration that instead of having some sort of document with all of the tariffs that make sense, they've literally released these tariffs to the world based on some big cardboard cutouts that they had that Donald Trump... Oh, no, that was the effect on the stock market. That's not the actual tariffs. The stocks are down, but the tariffs are up. And I think that the most curious thing about it, I think that has to be said, is that the tariffs seem to be based on absolute hogwash. There's no really clear methodology that they've used. Perhaps it was ChatGPT to calculate what tariffs are put on US exports to certain countries. Australia apparently puts a 10% tariff on the US. I was speculating that this is supposed to reflect the GST. I'm not sure if that's correct. I don't know where they got that tariff thing. They also called out Australia for not allowing their disease-ridden beef into our country. And we don't want their beef. It has mad cow disease, and they can't guarantee it doesn't. And what's more, as the Prime Minister pointed out, when you get beef from the USA, you don't know if it comes from Mexico or Canada or where it came from. So, of course, for biosecurity, we don't want their beef. And quite frankly, I say we should ban them from having our beef because they don't deserve Wagyu.
I mean, even beyond the biosecurity issues, I'm not sure why we would actually want to be buying imported beef anyway when we're already a massive producer and exporter of beef. We have absolutely no shortage of beef here, and it would seem to make sense that we would just eat our own fresh beef.
Look, I for one think we should probably export less beef and improve the quality of the beef that you get on the shelves. I mean, would it be that bad if we subsidize beef? I mean, we subsidize our power bills. Look, I've got no problem with supporting beef farmers should this affect them negatively, but I highly doubt that it will, given that the farmers that I want to support, they're already exporting their beef for top dollar to Japan or whoever wants the tasty flavors.
Yeah, and I mean, even in the absence of the US, there's plenty of other buyers for our beef out there, so I don't think it's a major concern. It was interesting, he didn't actually specifically say that he would be putting any tariffs on Australian beef, or it was kind of implied from what he said. It's not clear that exactly what, if any, changes will be made there. So it may just end up being the blanket 10% that we get hit with.
Well, in the best case scenario, he was flagging that as a bargaining chip, and then that's something Albanese can then go and look. If we're willing to accept your disease-ridden beef and bin it, will you go easy on us in terms of letting us keep socialized medicine without punishing us for that or something? Obviously, I guess the main game for Australia is just making sure that the US corporates aren't able to leverage Trump's management style to try and undermine our pharmaceutical benefits scheme, because that is what means that your grandmother or your mate's grandmother or whoever's grandmother doesn't have a lot of money can still get their medicines, basically. And so I think as Australians, that is actually something that we do have majority support for. So that's probably going to play well for Albo coming up with this election as well, which is probably the main point the Labor always wants to try and run on, essentially, is that the Medicare argument, which of course, it's years ago now that Abbott came out swinging against Medicare, but I feel like the Liberals are still suffering from that to this day.
Yeah, I thought actually Albo's comments were pretty reasonable. He didn't seem to be wanting to poke the bear, not trying to make the issue worse.
Views will no doubt differ in terms of what the best approach to take is dealing with Trump, but God knows I don't know, so I won't bother sharing mine. But it seems a reasonable approach to me is just be like, oh yeah, okay, we're just going to cop it on the chin and then try and back channel it to get any advantage we can. But like ultimately, there's nothing really to be gained from playing tit for tat with the US. But there's a lot to be gained in trying to stay in solidarity with the other countries of the world. So that may require some kind of action at some point. Let's see. Anyway, so look, let's move away from the politics and talk just purely about the market impact. How does this impact us investors? After all, the focus here is small cap investing. And on top of small cap investing, well, look, guess what? Small caps become large caps eventually if they're growth stocks. So, of course, we're going to be talking about growth stocks as well. Of course, the small cap that you bought 10 years ago, if it actually worked, if it was the thing you were looking for, now that's a big growth stock, right? And so I got a few of those in my portfolio. I'd say actually the majority of my portfolio, I wouldn't necessarily think of small caps anymore, because by the time they graduate from being small caps to large caps, they've grown as a proportion of your portfolio. So look, it does affect growth stocks most of all, because as a little refresher for the people that aren't fully across the way valuations tend to work, essentially anything that is inflationary ultimately pushes up that discount rate that you apply when you're valuing a stocks, or because it means that the return you want is higher. And when you make the discount rate higher, essentially that's going to punish higher growth companies more, because their earnings are further in the future. So something that has more earnings further in the future is going to suffer valuation wise as people notch up their required rate of return or discount rate, whichever way you want to frame it. And so that's why when we have these sort of like risk off events, you see the growth stocks that are on 100 times earnings generally fall more than the more defensive stable stock on 20 times earnings. So, it's good to have a little bit of, for me, I obviously lean way more towards the growth stocks than the general market does. But also, if you've been reading A Rich Life at all in the last month, you can see that, gosh, it was, I think, more than a month ago now, I put out the wake-up call. And that was obviously just about changing the risk setting of my portfolio and anyone else who wants to position themselves for a changing sort of market zeitgeist and market vibe. I think, when markets are hot, you tend to take on more risk because you want to basically capture as much of that upside while it's happening. Well, some time ago, the market stopped being hot. So I hope that most people probably got into a more defensive stance then, which is partly to maximize returns. You want to have more cash on the side to take advantages of opportunities that may arise if markets and valuations come down, which, well, they have and looks like they still are. But at the same time, you also just want to psychologically protect yourself. If you're way too exposed to risk when markets turn, then you're going to get kicked in the guts and you're going to stop thinking clearly because the emotions of seeing your whole portfolio down 15% instead of 7% can start shaking your resolve. And then, of course, Murphy's Law is some of you or some of me. I've done it. We've all done it. You time things wrong. You sell something at the bottom. I absolutely just wish it would never happen to me again. But sometimes you get in a psychological pickle and you're just not in the right mind frame. And then just as things are at their absolute worst, you start taking risk off. And of course, then things rebound. And that's why, unless you are willing to actively think about your own psychology as well as the macro world, you got to be very careful about doing any kind of market timing at all, really. The best, unless you're going to be very deliberate about it, the best move is generally to do nothing. And then the best move, if you're actually going to do something and think about it, is try and be ahead of the game. Try and be aware of the tricks your own mind might play on you. So we've actually seen markets come down a little red already. As I'm speaking right now, the ASX is down another 2% today, which is actually quite wild to me because we've had weeks of this build up to this thing. I actually thought that we might even see a kind of positive day today if the tariffs weren't as bad as the market was expecting. And as a result of that, I reduced my sort of hedge short positions, not mentioning any actual names. I reduced them yesterday. So, whoops. But nonetheless, I still do think we must be at least a significant portion of the way to the markets starting to price in what the likely effects of these tariffs are. But keeping in mind, I still think we could have a way to go before things actually start turning around. Certainly if stocks are green tomorrow, I'm not going to breathe a sigh of relief and be like, all right, it's all fine then. Because I think what the real kicker will be and what I'm worried about now is what happens when the tariffs actually start taking effect. What happens when that pushes up the price of goods in the USA? What do you think will happen, Patrick?
Well, I think the first question to ask is, are we actually going to see the tariffs take effect? We've seen in the past that often, Trump will make a lot of noise about tariffs or other things, and then in reality, we don't actually see that come through. So I think the first question we need to ask ourselves is, are we actually going to see this follow through? My feeling is we actually probably will here. Trying to guess what politicians are going to do is always a bit of a challenge. I think living by the principle of pay attention to what politicians do, not what they say, is a good one. So we have to wait and actually see if this becomes, law, if it goes, or it just becomes an executive order, however they decide to do it.
Well, that's right. So, but it also will be different from different countries. Like, presumably that's their end game is now everyone comes and starts bringing their offerings of thanks and support to the president in the hope of a slightly better deal.
Yeah, and I think you'll see vastly different reactions from different countries as well. I could definitely picture, say a country like Taiwan, who's heavily reliant on that US relationship, wanting to be more accommodating, whereas like mainland China, probably less likely to want to be accommodating. There's certainly going to be countries who won't accommodate at all. I think Australia got off pretty light. I think they'll probably negotiate fairly well, which partly does make it a little bit surprising that it's had such a big effect on the local market. The local market is priced more attractively, at least on a surface level as well. I think I was looking at the stats this morning. Where are we here? So you've got like the
PE ratios.
Yeah, the Nasdaq was sitting at about 26, 27. We had that was the S&P 500 at 27 or 29 on an equal weight basis. You've got the Nasdaq at 32 times, Australia at 18 times, and developed markets ex-US at 17 times.
Where was that data from, by the way?
I collected it from a few different sources because there wasn't a single source that I could get it from.
Yeah, fair enough. Don't worry about that. Anyone else can check and see how that changes and the elements there. I guess the thing that I was going to flag is that obviously the nature of the makeup of the index is a little bit different in Australia than the US. So I guess you'd expect the PE to be lower. Like, we've got mining companies and big banks. They're not exactly growth stonks. But yeah, look, I think that your point remains, which is it's not necessarily the same in the US as it is in Australia. And I think that probably goes to like the meta theme of the last month, which is that most people who have been taking action by reducing their exposure to the US. I've done it. You've done it. Half the world's done it. And also, if they've been doing anything, they've been increasing exposure to Europe. Because ironically, I guess the world is saying that this isn't so much likely to necessarily immediately boost US manufacturing, but by behaving in this way as a bad ally, it's going to absolutely boost manufacturing in Europe. And fair enough for Europe as well, because they're actually, the original industrialized society. So people forget that just because China makes all your gadgets and your gadgets, Europe still manufactures the machines that make the gadgets and the gadgets. For lack of a better analogy, ASML is the classic example of that. The country, the big Netherlands company that makes the machines that then TSMC uses to make the chips that then US companies use to make the end user program, whatever it is that half the world uses. So yeah, look, this is a big strange thing that's happening, and I guess, look, now let's bring it back. So yes, okay, it's going to be different here than in the US. Yes, okay, probably in our lives and our portfolios. Like, what have we done about it? Well, since I wrote the article a month ago, I've reduced my exposure to the US. Already done. I've cut, all of my lower, or most of, if not all of my lower convictions Australian position. I've just got one more I'm holding on to for now. Probably get rid of it soon. And on top of that, I've bought a lot of gold, basically, which has gone on an absolute tear, like actually proving its worth. Bitcoin not quite doing it for me as the digital gold yet, like acting like a tech stock, which is fine, but I've got tech stocks, so, doesn't really give me the diversification I'm looking for. So look, overall, still, are you going to be taking profits on gold after this, for example? Because I know you have a fair bit of gold in your portfolio as well. What are your thoughts there?
Yeah, I have actually been tempted on that front, to be honest. I've been in gold for a while now. I kind of actually see it as a permanent holding in my portfolio to some extent. I wouldn't want to see it in double-digit percentages. It is getting close to that, so I'm kind of considering taking some of those profits. But I think holding gold as
then the question is, what do you put it into? What if you take out of gold? What do you put that capital into?
To be honest, right now I'm actually pretty happy holding cash. I have been looking
AUD cash or USD.
Yeah. I don't think I really want to be holding US dollar cash at the moment, though I think there's a reasonable argument to be made for holding potentially euros, maybe pounds, maybe even Japanese yen. Like the yen has done pretty well in recent times. They've been raising interest rates for the first time in decades there. If you were going to hold cash, I wouldn't be I don't think it's crazy to be holding yen.
All right, just quick legal notice on that, guys. We are not currency traders, not encouraging currency traders. This was just a purely me trying to get a picture of how Pat's positioned. There's definitely not any kind of advice.
No,
none of us have any real opinion on that. That's pure flippant entertainment.
And look, I think as well, there's a difference between like currency trading and just holding currency exposure. I mean, currency trading is usually quite, short term, often highly leveraged. It's absolutely not what I would be referring to here.
Yeah, we're just sharing how so people will know how we're coming from. I think it's relevant, right? Because, for example, my share portfolio does have a lot of, I guess, high risk growth stocks in it most of the time. Obviously, during certain periods where I think there's a bear market going on or coming or starting, I basically try and reduce that risk massively and do some things to try and take some of the pain out of the inevitable drawdown. But it also makes a difference where you are in your overall life, right? Like if if you have, for example, own your own house, that's a big inflation protection thing right there. So gold could also be thought of as inflation protection. Another inflation protection thing could be, you own a house and you're paying off your mortgage and stuff like that. So I think, land is considered inflation protection. I won't get into the property bubble in Australia right now, but, I don't. Anyone who's been saying it's going to burst has been being wrong for like 20 years. So we'll see. The point is that these tariffs are inflationary, right? So there's no doubt about that. If they actually start applying these tariffs to the US, then that means certain goods are going to go up in price for the end consumer in the USA. That's going to be inflationary. Now, I don't know exactly how that plays out, but I think by and large, it's going to be bad for the growthy, high beta, tech stocky kind of stuff for the reason I just said before. Having said that, especially in the portfolio of a Rich Life recommendations, I have tried to balance it out to have some companies that have some kind of mechanisms that help at least modify or make the impact of inflation not so bad on the business. So, the classic example is what inflation really basically means on a really basic level is that the dollar price of things is going up. Okay, so really what's happening is the dollar is going down in value, but the dollar price of things is going up. Well, that makes life easier for companies that essentially charge their fee as a percentage of the dollar value of things, because their fee automatically goes up in an inflationary environment. Whereas a company that has some sort of fixed fee style situation, they don't do that as easily because they have to maybe push through price rises constantly, and that will happen. But it's not as it's a psychological thing. How easy is it for you to raise prices? That becomes a very real thing because inflation means everyone's raising prices. Well, how easy is it for you to raise price without creating churn, without losing the customer? Becomes a big factor in your business. This is the time when pricing power gets tested. The time when Buffett said all of his really phenomenal things about how to invest in quality companies, when he said this is looking for companies that can reinvest at high rates of return. We're looking for pricing power. We're looking for moat. All of this came from his letters in the period when the world had higher inflation. This is when he learned these lessons really hard that and shared them with the world, mind you, that the companies that ultimately do the best in inflation are pricing power companies, i.e., a proxy for the exact kind of high quality businesses we've always been looking for all this time, or at least I have. Each have their own style, but this has been the inspiration for my whole investing is those old 70s and 80s letters from Warren Buffett where he spelled out how to do this. So the actual strategy doesn't change, but keeping in mind the multiples will likely come down if inflation raises its head again. So that's my take on it. Overall, I basically still think my thesis that I outlined in my wake-up call on the 5th of March is basically in play. I remain bearish for now, but mindful that, we've had a bit of a drawdown now, and I'm not going to be increasing my bearishness from here. I don't think if anything, might be starting to deploy into the ideas that I like that have gotten smacked down, and of course I might even deploy into the ideas that I like that haven't gotten smacked down, because sometimes the fact, especially that a small company isn't getting smacked down when the whole market's getting smacked down, sometimes that's a little clue that there's underlying demand for the shares in that stock that is not resulting in a share price rise now because the overall market is so bearish, but may well lead to a good share price rise once the market warms up again. Now, I just wanted to, put a pin in that subject matter because we do have some small cap news that we've dug up to share with the listeners. Are you happy to move on with that, or do you have any last final thoughts on the world of tariffs that we're now venturing into?
No, I think we've covered it pretty well. Yeah, let's get into the small cap news.
All right, well, I guess I can kick it off then. I'll start with a company that I've followed for pretty much its entire listed history and even briefly owned shares in, called PlaySide. Now, PlaySide Studios, I do not own shares in this, by the way, and haven't for a long time, but PlaySide Studios listed to a bit of excitement, really, in the heady sort of pandemic days where markets were quite hot. And the pitch for PlaySide, I suppose, is that it is a video game company in Australia. And obviously, video games are growing, right? So that piques the interest of many market participants. Now, they made their money in two different ways. One was, I guess, this work for hire business where they would, develop games on behalf of other companies and basically, sort of fee for service style business. And then the other is they had this sort of original IP games that they develop and try and sell, which they've had, some of them have had some sort of varying degrees of success. I think when they first listed, sort of the Animal Kingdom engine was their sort of biggest original IP game. One thing that I always thought was, when I was sort of sharing my views on this stock with various different people, I sort of started beginning to realize that in the equity world, in the world of brokers and finance and PlaySide stock, a very few people, if anyone, that was even recommending the stock has actually spent any significant amount of time playing their original IP games. And if they have, then they also are not gamers themselves, or something's really weird about them, because I don't think you have to be that clever to realize that most of their original IP games are not that good. And I'm being very generous. So I just don't see anything valuable yet. Now, of course, there's always the option that they'll like hit on a winner, which I guess is probably the most reasonable thesis for owning the stock. Now, with that little broad overview out of the way, I guess the recent news with this company is that the founder, Jerry Sakis, has sort of stepped down as CEO, and Ben Skender, a former analyst actually, who I think, I'm not actually sure if this is not confirmed, but may have previously even covered the stock. I haven't seen any of his research on the stock myself, so I can't confirm that, but that's what somebody told me. And he's actually become the CEO now. And this is off the back of the founder having sold down shares. Was it last year that he sold down shares, or in 2023?
I think it was last year. I did see an announcement that referred to 2024 from memory.
That's right. Yeah, you're exactly right. So it was actually about this time last year, not that much more than a year ago. It said that PlaySide confirms that its three largest shareholders and co-founders of the company they've agreed to sell down 40 million shares in the company. That was at 75 cents per share. So well done to those fellas. Absolutely not the patsies at the poker table. Cashing out to the tune of $30 million. Ooh, that's some play money. $30 million between the three of them at 75 cents per share. Now, the guys that bought those shares, if they held them the whole time, they could sell those shares for 17 cents. Ooh, wow. How would you feel? Imagine being the fund manager that bought Jerry's shares. It's like, you'd have to look in the mirror and say, what am I doing with my life? Anyway, you don't want to buy shares off him. That's what I reckon. But at the same time, now they're 17 cents per share, so that's a different story, of course. And actually what's happened is that the CEO has come in, his options get priced from the 7 trading days subsequent to March 20. So we're still in that period now where the value of the options that are going to be given to the CEO, the new CEO, for his remuneration, that is being calculated. So the lower the share price trades now, the lower the exercise price of the CEO's options. And so we've got a few more days when we're still in that zone. From memory, I can't remember. We're a little bit more than halfway through the period where that's calculated. So He'll probably get his options sort of at the end of next. I think it goes to April 9 or 10 or something like that. And then after that, they'll price his options, could be around 25 cents in that sort of ballpark. And then if he can get the share price up to just 50 cents, for example, way lower than what even they sold at $30 million worth more than a year ago. If he can just get up to 50 cents, those options will be worth like at least whatever 2.5 million or something, 10 million options he gets. So that's on top of the salary of 500k minimum plus STI bonus. So overall, huge incentives for Mr. Skender to get the share price up in the next few years. He's started by, I guess, reducing the number of employees, hence why they're talking about the recent announcement where they're saying there's going to be operational restructure. And I think it was up on the screen there. It's going to be upfront cost of 1.5 million. So I guess that will come through in this year. I'm guessing they're going to be excluding that from underlying EBITDA or whatever they're reporting on. And we'll see what happens there, basically. But look, these guys have done some interesting things over the years. Like they sold NFTs for a while and actually made like a bunch of millions of dollars out of just selling NFTs. That was the end for me. I was like, yeah, I'm never going to buy shares in this company pretty much after that. But, I guess now I'm rethinking it. Now it's actually down so much. I'm like, oh, yeah, well, the NFT companies turned out as good as I thought it'd be. But I mean, is there something there now? Like, I'm more interested now, I have to say, even though I previously was like, yeah, put it in the bin, I'm done. Now, if it gets low enough, I sort of start getting interested again. So, the incentives are there for the CEO, certainly, to get this thing back up at some point in the future. So, I don't know. There's a cynical angle there. I don't own shares myself and no immediate plans to buy, but yeah, the scrappy side of me thinks, I could imagine it getting hyped up again in the future. Having said that, not particularly excited about stock will get hyped in the future kind of style theses in the first place.
Yeah, it doesn't really instill a lot of confidence in the business model if the thesis is the stock might get hyped up in the future. I think that's probably one I'd sit out.
Yeah, not the best. Anyway, you want to take us off? What's the next bit of news we got? I know you've got some in there to share.
I sure do. I'll go through a couple of very quick ones first. Sorry, that's the wrong announcement. Here, we'll bring this up. I just thought this one from Bain Capital and Tower was interesting. So Bain Capital is obviously a private equity company, owns 20% of Tower Insurance, which is a New Zealand-based and listed, but also cross-listed on the ASX in general insurer. They are selling down their entire stake, and the share price wasn't particularly appreciative. That was down around 10% on the announcement and finished down about 8% for the day. I bring it up just because I thought it was an interesting reminder of the risks of having, large private equity holdings on the register of a company. Generally, private equity companies like to exit their holdings at some point, and if it's a big piece of the pie, it can hurt when they do. I'm sure there's probably a few fund managers who would have got some shares at a reasonable price as part of that. But it's just something that I like to look for when I'm assessing a company to see if there is that risk of a big sell down.
Yeah, it's worth acknowledging. In fact, I actually just find usually private equity companies are not my favorite to invest in, just sort of generally speaking. Sometimes they work out well, but, often there's a bumpy period and often there's a temptation for, private equity to take a company private. I have no idea about this stock, by the way, Tower. Never looked at it, not opinion on this stock at all, but very typical for them to take it private, fix a few problems, maybe take some bitter medicine in the start and then get things looking better in a couple of years. Layer a little bit of debt on there because why not? Get the earnings looking good, then list it and try and make it like have a couple of good years and sort of set it up for a good run if possible, and sort of time it well. So then a few years later, the company looks like it's pumping on all cylinders, but what you don't see, typically for a software company is that, while the company was private, they spent a bunch of money, developing a product or something like that. And then they started selling it. And then they listed it once they just developed this product and let go half the IT team after they didn't need them anymore. And, some of their other products are getting old and they haven't updated things, but they're like running just with what they've got and getting as much operating leverage as possible. And they start selling a new product and it works, and they've invested more in sales, and then they sell more and it looks good for a couple of years. But what you don't see is that, this other super important product is in decline and needs a huge update. And, yeah, sure, they've got some growth now, but like the other big part of the business is creaking at the seams. And, I look at a lot of software companies, so I think of it in this regard. It could be that there's a huge software project investing they're like going to need to do, and you don't know this as a public market investor. You pay too high a share price for it without realizing that you're about to get hit with a multi-year reinvestment program or something like that. So that's just one example. But yeah, look, sell down could be an example. It could be a good time to buy sometimes if it's just simply, there's extra liquidity at the moment. Now those shares have gone to a good home potentially, and sometimes it can be an opportunity for the share price to rebuild after that as well. But the market's just digesting a big chunk.
Yeah, potentially. I don't have a view on the stock either. I don't hold it. I just thought it was a good example of being aware of who is on the register. Another one, again, not one that I hold, but just worthy of note, a little bit sad in my view. I don't hold Domain, never have, but it is, an Australian built and grown company, and it looks like we're going to be losing it to a US buyer. We don't have a massive depth of, tech and software companies available to us, particularly at the larger end of the market. So it's a little bit disappointing as an ASX investor to be losing another one of those. But yeah, it looks like this company, CoStar Group, which is listed on the NASDAQ, will be purchasing Domain Holdings.
Yeah, so that's not guaranteed, but basically they improved their offer to $4.43, and now the Domain Board has unanimously determined to engage with CoStar to facilitate due diligence. So not really 100% guaranteed that it will go through, but it is looking reasonably likely with the shares now trading at $4.26. So, what is that, like around a 5% discount to, the final takeover price. So the market definitely creeping towards the conclusion that it will get taken over by CoStar. So yeah, that's okay. I guess at least it shouldn't be too impacted by tariffs, etc. On top of that, my next one was going to be MetAdvisor, which is a pretty bad small cap over the years, actually, I would argue. About $52 million micro cap really nowadays. Just a terminal disappointer. These guys do have some fairly sticky pharmacy software that they use in Australia. They have a lot of at least two different kinds of, maybe they've combined them now, but two different kinds of software that allows pharmacies to essentially communicate with people who need to fill regular scripts. Essentially, it's a customer retention tool for the pharmacists that allow them to sort of know when people need to pick up their scripts. People can even sort of apply for their script to get filled via that MetAdvisor app, and then go into the pharmacies subsequently and just pick it up. It should be ready for them. And so that is a kind of pretty good business on the consumer side in Australia. And if the company was really focused on running these little sort of legacy software businesses that have a good market positioning, if they were really there about just making that software as successful as possible, and I guess expanding the modules that they can do for the pharmacy and sort of muscling in there, it could be a really good business, especially if they were running at break even while they were doing it. But it just not like that at all. Like, they bought this sort of weird old business that's sort of very vaguely similar in the USA, that also has to do with sort of similar pitch that allows pharmacies to outreach with potential customers to get them to come in for services, stuff like that. Programs like vaccinations, by the way, which is definitely not a big priority for the new US administration. Oh, by the way, the one that they bought is a US company, right? It was a very classic diversification play. All of the board that overseen this whole thing, they're still in there. Nothing's changed that I understand. Like maybe they've had a little bit of change at the the CEO has changed and stuff like that. But overall, the general makeup of this business is just however it's been. They just raised capital, $5 million at off a price of 10 cents per share. Of course, it's now trading at 9.5 cents per share. They just really are remarkable, and you should go back if you're ever thinking of investing in this company. You should definitely go back and look at how much like senior management have gotten paid over the years, because for such a small unprofitable company, it's always struck me they're just so generous with how much they pay people. So yeah, wow, like shareholders definitely called that one wrong with this thing sitting at multi year lows here. So that's the life of a microcap investor. Unfortunately, when it doesn't work out, these businesses just have to continually raise capital because there's some sort of pathological inability to run at a profit. So I think, I covered off Medadvisor's news there, but that basically is, just raising capital at the bottom, and it happens. I've been caught in other ones that do the same thing, and it's just always just like devastating because it like locks in that lower share price and the impact that has with the dilution then. So yeah, tough gig for these guys. Don't see the tailwinds switching around anytime soon. Also, this whole US business they bought never looked particularly attractive. So there we have it with MetAdvisor. Still got the cap out all these years later, 10 years on the ASX or more, and they're still asking for money. So there you go. Oh, by the way, I should add one reason I think that they're interesting is EBOS Group, EBO, a much larger company, is an investor in MetAdvisor and has invested multiple times over the years. So not sure what their take on all of this is, but there's definitely some well thought of backers in that shareholder. So that's why I do sort of keep it on the watch list, because I could imagine there's a price where it would be worth the risk reward.
Yeah, I think the point you make there about the dilution for these small cap companies is a very important one. As part of my process, I always like to have a look at the history of the share price count over the last few years. I think that's a good habit to get into. If you can find a data source that will give you a 10-year history, I think that's really, really useful.
Yeah, honestly, as a single signal in small caps, that just looking at the dilution over 10 years or something like that is very useful.
Yeah.
Yeah, so these guys have more or less more than 5x their shares on issue since 2016. About 100 million shares on issue back then, looking at 550 million now. So, the main thing here has been like finding people to take the shares as currency. That's been how they've unlocked wealth for I guess the people who actually receive the money, which is the employees, etc., who, as I've said before, I consider to be fairly well paid, given the lack of returns for shareholders. So anyway, could be a down point, a low point in its sentiment, though, I guess. So I'm not 100% negative on it, but it's just way too far away from the droid that I'm looking for in terms of like those high quality businesses. I reckon I'd love this one though if they could ever just get that software asset in Australia, focus on that, and try and make that both profitable and growing. I think it could work. But yeah, no, they've been going for the empire. The international empire build has occurred, and shareholders have paid for it.
Moving on to a stock that I don't own, but I have written about it before, which is the Environmental Group. They're an industrial business. They do boilers, and a small part of their business is very small, is some technology about PFAS, which is a certain type of plastic that a lot of places are looking to take out of their water and soil as it has bad effects on human health. I don't think it's actually as big a part of the story as some would.
I will say though, just on that PFAS thing, like I think that this has been massively hyped. Like I can remember this PFAS angle for environmental group being hyped up as, some great reason to buy the stock like 3 years ago or whatever. I think they still have almost completely negligible revenue and certainly no profit from that sort of segment. It's just like remarkably overhyped aspect of their business. Like it's just like the angle that, in my opinion, essentially people see. What's happened is people seeing this stock, right? The environmental group. Oh wow, like that's the kind of name that like ESG investors want to get behind, right? Oh wow, I'm gonna like invest in the environmental group. Going to be good for the environment and make money. Yeah, fantastic, right? So it's all that simple. And then essentially just hype this like PFAS angle, which to be fair is good for the environment, but it's like none of the earnings of the EGL group business. And yeah, even like this other ASX listed company called SciDev actually does have a PFAS business, and it's, by the way, doesn't look like a super high quality business either. So it's not like this PFAS thing is like your golden ticket, like a monopoly or a network effect or anything like that. It just seems like it's, from what I can tell, like there's no proof that this is like some high margin business either. Like I have no idea what the margins in PFAS cleanup are going to be, but yeah, just hugely overpiped. Like I don't know, so I had to just put that in because I just feel like, how has environmental group gotten this like halo effect of this PFAS thing when it's like basically nothing to do with its business in terms of the actual profits?
Yeah, no, I agree. I was probably being a little bit more soft on them, maybe, but it really is. I don't think they're earning any revenue from it, and if they are, it's not enough that it's significant. They do have other areas of their business that there is a genuine kind of environmental angle to. They do recycling. They also do upgrades to gas turbines, which allow them to operate as firming for renewable energy. And I do think those are important things. But definitely PFAS has been a big part of the narrative for this company. Back to the
actual news.
the
Today's
actual
news.
news. They have acquired a Boilermaker, which is not particularly exciting. They paid a pretty low price for it. They have quoted it on an EBITDA multiple. Normally, I wouldn't be too interested in EBITDA, but given they already have a boiler making business, it's possible that the depreciation and amortization are not actually going to directly come across from that business. They may be able to, they may have existing assets. The reason I thought this was interesting, though, is that when I was writing about the business, one of the big questions for me was like, how much of their business is services versus how much is products and installation. Obviously, services tend to be more ongoing, though it does depend on the nature of those contracts. So this business that they've acquired is actually 60% services. Now, that may not translate across to all of their businesses. In fact, I would be very, very surprised if it did anywhere near that number across the business, different business divisions. But I'm not going to lie, it's a much higher number than what I would have expected for any kind of business in this industry. So perhaps maybe the number's a little bit higher than what I would have expected. It's not disclosed separately in their statements. If I had to take a wild stab, I would have thought maybe somewhere in the range of like 10 to 20%. So it was surprising to see it as high as 60%. Don't know what that means for the rest of them, but it was just a little bit of an insight, a little bit of a clue as to the nature and scale of what the services businesses can be in this industry.
Yeah, good pick up on that. I think just because that does hint at, a potential thesis, generally speaking, if you are going to be investing in small cap companies, you want to have, look, this is just the way I invest. There's people can do different styles, deep value, whatever, dividends. But I generally am looking for some sort of improving quality of a business, which is definitely can help, fire up growth or allow the business to prove itself to be undervalued. So anytime when you're seeing the quality of revenue go from, I guess, one-off to slightly more recurring, generally that does mean an increase in the actual quality of the business, because essentially a business that has less lumpy revenue and thus can achieve more sustained profits generally gets a higher multiple, just because it's easier to predict, or people feel more confident about where its profits are going to be next year, so they want less of an equity risk premium, is basically how it works. So improving quality is a green flag that I like. Whether this is actually improving quality, I don't really know. And also there's always the risk with, multiple like serial acquirers, that basically they can be just using acquisitions to constantly try to, paper over actual performance, not being very good. Like, it's relatively common for serial acquirers to end up in trouble, because you're often just dealing with counterparties that understand what they're selling you better than you understand what you're buying. So there has to be some sort of like secret source of why the acquisition thing like really, really works, because just generally speaking, acquisition-led growth is not the best in my point of view.
Yeah, absolutely. I would agree with that. I think you should be looking very, very closely and carefully at any company that's made, multiple, particularly if they're significant acquisitions in recent years.
Yeah. Okay, so last one, Kinatico, I think it's called. Used to be called CV Check. You got? Did you want to cover the news for that one?
I didn't actually have any. Yeah, I
Oh,
didn't.
there's no news on that. That's right. I was just going to. Why did I bring it up again?
I'm not sure. I was a little bit confused. That's all right.
We're chatting about it.
We were chatting about it because it was one of the companies I was covering. But
that's right. Okay, so that's going to be in an article coming out, is it?
Yeah, exactly right.
Great. Now we can leave that in. That's good to know. You check the website for the upcoming article, or is that going to be in Livewire, that one?
It will be, yeah. It should be up in the next
exciting.
day or two.
Look forward to reading that. Okay, well, that's it then. So there's just one last thing for this show, which is the question without notice. So I guess my question for you is, what commodities do you invest in, and just why for each one?
That's a good one. So
I'm not much of a commodity investor, of course, but I'm just interested to hear your rationale, and then we can hold you to it later.
Yeah, no, that's good. So my biggest exposure at the moment is both to physical gold and to gold mining companies. I own some individual companies as well as an ETF that includes.
Yeah, just let's talk about the exact commodities, because keep it simple. So why do you like the gold commodity?
Look, I like gold in terms of physical exposure to gold because I see it as a good hedge against uncertainty. When the world goes crazy, people often turn to gold. Over the very, very long term, it has also been shown to be a good inflation hedge. Now, I'm not talking about 5, 10, 20 years here. I'm talking more like many decades to hundreds of years. But I think it's a good way to preserve wealth, though not necessarily to build wealth.
All right, what other commodities? What other commodities have you got?
Yeah. And the other major exposure I have is to uranium. I have been involved in uranium for quite a long time now. Took some profits in recent years as the prices got bid up. It is essentially a supply and demand story with that. People have focused a lot in the last year or so on the spot price. The spot price is absolutely not relevant to most producers or buyers. It's the contract price that matters. That has continued to go up. In the years ahead, there is simply not enough uranium coming out of the ground to cover the requirements that nuclear power plants have around the world. China in particular, but many other countries are continuing.
And that's
to build
based
out.
on what, like your own research, or is that someone else saying that you're putting their weight on their word, or what? Why do you think that?
Certainly on my own research. I've been covering uranium for 7 or 8 years, but there are many researchers out there who would agree with that, and I can't actually think of many who would disagree.
Yeah, so the risk is, of course, that we end up using less uranium. I guess for a while there, people were closing nuclear plants, but I'm not sure that that's just happening as much anymore.
No,
they're even reopening some, maybe.
Exactly right. Yeah. So the trend has actually gone in, and that was part of the reason the price got so low during the previous decade was following Fukushima, Japan shut down all of their reactors, Germany turned off theirs, and there was a bit of a move away from nuclear. But with the whole electrification, also data centers, there's been a shift in recent years towards extending the lifespan of existing plants, and even restarting some plants that had been off previously. So it does look like there is growth in the years ahead. Even if there wasn't significant growth in numbers, though, the lack of new supply coming online and the eventual tail off of major producers' existing mines would bring down that production in the years ahead as well.
All right. Well, thank you very much for that impromptu soliloquy. This has been a long episode already. So thank you also very much for our two listeners. We have just started this podcast, and we really appreciate your support, your likes, your shares, like telling your friends about it, giving us a 5-star review, anything really to draw us to the attention of the algorithm. And because, you know, it is ultimately the algo gods that we serve and survive on. So thank you, algo gods. Please boost us. We love you.
Good to chat with you today, Claude. And we'll be back in the next couple of weeks with another episode.
Thanks, everyone. Have a great day.